Episode 5, The Crash of 1929, When the Music Stopped. October 24th, 1929, Wall Street, Lower Manhattan. The morning bell rings. Brokers rush to phones. Tickers whirl. Within minutes, panic spreads across the trading floor. Prices plummet, men shout, papers fly, and fortunes vanish. A few days later, the New York Times will call it Black Thursday, and historians will later call it the beginning of the end. But for those living it, there was no label at the time, just utter disbelief. Today, we're diving into how the illusion of prosperity covered in last episode unraveled, why the world's smartest bankers, our 4 bankers we discussed, couldn't stop it, and how the crash of 1929 transformed capitalism forever. The 1920s had been one long party. We talked about the jazz music and Hollywood and prohibition, but everyone's actually out partying and drinking. And from a business standpoint, industrial output had soared. Consumer credit had exploded. Remember, consumer credit didn't even exist prior to the 20s. People are borrowing money for everything, not just we think of houses today. Obviously, we use credit for everything today, but people start buying these new technologies like telephones, washing machines, etc. So while that consumer credit is exploding, stocks are also just going through the roof. They doubled and then tripled and then doubled again. And so by 1929, the Dow Jones Industrial Average, which was the index of the time, the S&P 500 wasn't around yet. Obviously, we still have the Dow today, but it had quadrupled from its 1921 lows. And newspapers called it a new era of permanent prosperity. We've heard that one before. In the 2000s, there was a quote, I'm going to butcher it a little bit, but that stocks have reached a new permanent high or something. It was very similar. And then we know what happened next with the dot-bomb implosion. So presidents, economists, and business leaders echoed the same chorus. This time is different. And behind the scenes, it was a different story. Okay, corporate profits had stagnated. So stocks are ripping, but the profits in a textbook version of the markets, stocks are supposed to follow corporate profits. Does that play out in real time? Of course not, because we're humans and euphoria can creep into the markets and stock prices can become detached from the actual fundamentals. So on top of that, wages were lagging behind productivity. And then debt levels, personal, we talked about that, consumer credit, but also corporate, were unsustainable. So it wasn't a bubble fueled by innovation like we talk about today. Are we in an AI bubble? That's a bubble fueled by innovation. We know there's a new technology here that's pushing this. Now, have we gotten out over our skis? Probably. We'll find out in the coming years. But this bubble was pretty much just fueled by leverage, by borrowing. So every bubble has its own mythology around it. In the it was the internet. We remember throw .com on the end of your company's name and watch your stock price triple overnight, famously pets.com, but there were countless others. Then in the 2000s, our next bubble was real estate. We've all seen The Big Short. I'll actually be putting out a blog on the 15th anniversary 10th anniversary of The Big Short here in the coming weeks. But in the 2000s, it was real estate. We've seen, strippers in Florida owning 7 houses, these adjustable rate mortgages that the second they adjust, the borrower can't afford them anymore. But in the 90s, the bubble was the stock market itself. It wasn't just a sector, it was the whole market. And they called it the great democratizer of wealth. We hear that, guys. Anytime you hear we're trying to democratize something that ends in the party that's democratizing it getting paid, it's probably a good indication there's something a little fishy going on. So margin loans were the fuel for all this. And to give you some of the numbers, investors could buy $10,000 worth of stock with just $1,000 down. We call that 10 times leverage. And like always, as long as prices keep rising, everyone gets rich. In fact, you get rich 10 times as fast because you're 10 times levered. But the same leverage cuts both ways. So when prices fall, margin calls come. And when enough investors get margin calls at the same time, the panic just snowballs. And a margin call is basically when the equity, the value of your stocks, becomes worth less than the debt that you've taken out against it. The term you would use is underwater. So one trader put it this way: it wasn't selling, it was liquidation. Selling implies that it's a decision to sell off. Liquidation is forced. Like, you have to sell this because you're getting margin. 4 central bankers we've been following throughout our series, Strong, Norman, Rowe, and Schacht, were all in their own ways complicit in this downfall. So Strong is the New York Fed chief. He had actually passed away in 1928. Remember, we're in 1929. He doesn't even live to see the crash, but he was kind of the steady hand, if you will. Probably my American exceptionalism showing a little bit, but he was the big dog. He was like Jay Powell today. He had real global influence over these other bankers, and honestly, his successors that stepped in lacked his steady hand to oversee a crisis like this. Now, Norman, he pushed Britain back onto the gold standard at an overvalued rate. Remember, he's so tied up in British ideology and returning to the glory days. And so he's just, come hell or high water, he wants to get the pound back to its previous rate. And what this did is it strangled exports and it drained liquidity. And when you're in a crisis and there's no liquidity, bad things happen. Now in France, Moreau continues to just hoard gold. And this has the effect of just tightening the noose on global credit. He's just pinching pennies over in Paris, or more accurately, pinching gold and not copper. And then we got Schacht in Germany. He's the guy, he has the least cards to play. They have reparations, but he really is kind of almost a bystander, just trying to survive at this point. And he doesn't have a ton of control over what's happening, but he knows how dependent Germany is becoming on foreign debt, but there's really nothing at this point he can do to stop it. So by 1928, a year, remember the crash happens in 29, the world's monetary system is totally out of balance. Gold was being sucked into vaults in New York and Paris, while the rest of the world starved for liquidity. And so when the music stops, to take the analogy a step further, there are no chairs left to sit in. So the crash didn't happen all at once. Let's take it step by step. On Thursday, October 24th, panic selling begins and 12.9 million shares are traded. I know that's a bit of there's no context around that, but that was an all-time record for shares traded in a single day at the time. Okay, that's the 24th. On Monday, the 28th, the Dow fell 13% in one day. For perspective on that one, I think the worst day during COVID, we maybe lost 9% or so. We lost 13% in a day. And then on Tuesday, October 29th, the day after the Dow had just fallen 13%, bottom falls out. 16 million shares were traded, breaking the record that was set 5 days before. Billions in paper wealth just go up in flames. So what happens? Banks step in and try to buy the stocks to stabilize prices. And this works sometimes. We saw the Fed jump in and buy assets during COVID, for example. And we've seen previous to this, we did an episode on the panic of 1907 where JP Morgan stepped in and started buying. And so it has worked before. But this time it didn't. The panic was psychological now. And understand, these banks know that if this thing, the bottom falls out of this, they are going down with the ship. And so they're not stepping in to buy stocks out of like philanthropy. They're doing this because they know that their livelihood is on the line as well. And so maybe you've seen it. There's an iconic photo from that week, and it's a crowd gathered outside the New York Stock Exchange. Everybody's necks are craned. It's black and white, but you can just imagine their faces are pale, panicked. And they sort of knew it, but they didn't know it yet fully. But the world they'd known for a decade, the roaring 20s, it was gone. Say goodbye to the jazz in Hollywood and hello to Breadlines. So the US crash, it didn't just wipe out American fortunes. It detonated the entire global system. Europe's fragile economy, remember, they're coming out of the war much more damaged than America is. None of the fighting in World War I occurred on U.S. soil, and the U.S. didn't. They came into the war later on. They left the war in a good place. But Europe's fragile economies depended on American loans. They're in a bad spot, but America is sort of their lifeline via these loans. And so when Wall Street implodes in 1929, that money vanished. And so here's what happens next, okay? Germany can't pay their reparations. We already know they were struggling mightily to do that. They were basically just robbing Peter to pay Paul, if you will. They're borrowing from America, using the money to pay France and Britain, who are then funneling the money back to America. That circular economic arrangement that we've talked about in previous episodes. And so then France and Britain can't pay their debts to America. They need Germany to pay them so they can pay America. And then global trade just collapses. So this circular debt machine that had kept the world at least turning, maybe not flourishing, and this is crazy. Within 2 years, unemployment hit 25% in the US and 40% in Germany. So the biggest financial crisis we've had since the Great Depression was the crash of 2009. I think unemployment hit 9 point something percent. We hit 25% after this stock market crash. So the irony is probably that in some ways, everyone knew it could happen. I mean, so Roger Babson was one of the few economists to flat out predict the crash. He said weeks before the crash happened, sooner or later, a crash is coming and it may be terrific. And that's we hear people, there's more access to information nowadays. Everybody has social media. And so we get a lot more of that because anybody with an account can go on there and just predict economic calamity and really never have to answer for it. But back then it was, people read things in newspapers. It's not like we all just had access to each other at all hours of every day. An economist coming out and saying something like this is somewhat meaningful. But of course, everybody's getting rich, okay? So no one wanted to hear what he had to say. Not the public, because they're all getting rich. Remember, taking out 10x leverage loans, 10x leverage to buy more stocks. The politicians, they don't want to hear it because what do the politicians want? They want to get reelected, and coming out and being negative and telling people what's about to happen, that's not beneficial either for them. And certainly not the bankers either, because they cause a panic. What happens? Everybody goes, there's bank runs. And remember, there's no Federal Reserve at this time. So if there's a run on a bank, there's no federal bank left to bail them out. And so this is a lesson around incentives. These people, the public, the politicians, and the bankers, them believing that something horrible is going to happen or even advertising it has negative consequences for them. And another bias we see creep in here, I've written about this, it's confirmation bias. What do we want to happen? Of course, we want to keep getting richer. We want our portfolios to go up. I'm a real estate investor. I want my real estate to go up, but it blinds us to the downside sometimes. And there's no wiping out confirmation bias for any of us. The best we can do is try to be aware of it. But what happens is we, in our heads, confirm the thing that we want to happen because believing in the inverse of that outcome is so damaging to us that it's too much to even try to fathom. So we just turn a blind eye and assume the they're not going to pull the punch bowl away from the table. Party's going to keep going. So greed, optimism, and pride, those are the constants in every financial cycle. I would add fear to that, fear and greed. Technology changes, markets evolve, right? The market today, technology today, they're completely different. Could get a time machine and take someone from 1929 and plop them in 2025. They would be utterly confused by the world today. But what would not change is human nature. That stays the same through every cycle. We harp on this all the time. Fear and greed. Fear of losing it and greed at missing out, or FOMO, or seeing your neighbor make a bunch of money and you missing it. That stuff never changes. So in the years that followed, the world fell into chaos. Banks failed by the thousands. Today, we'll see banks fail from time to time, famously like Silicon Valley Bank a couple years ago, but by the thousands, pretty staggering numbers. Farmers lost their land. We talked a little bit last episode about the Dust Bowl conditions that were created in the plains and how the land was destroyed and caused one of the greatest natural disasters in history. And then the Depression only compounded on what had already happened. And these farmers lost everything. And then, we've all seen the photos, cities filled with breadlines. And this is where I'll see people post on LinkedIn, like, because I would agree, we are probably in a bubble right now with AI. And I see all these comparisons with, this is the new 1929. And I'm like, stop right now. Like, shut up. This is so disingenuous. We are not going back to breadlines. We can have economic crashes. We did 15 years ago. We can face hard times. Breadlines are a thing of the past. I think, and none of us lived through 1929, so we don't know exactly what it was like, but this is a different universe as far as what people in America and across the globe went through. Okay, 2009 was not 1929. If we see a crash here from the AI bubble, it's not going to be like 1929. I will go on record saying that. Back to our story. So in Germany, we know what this leads to, and it's a very dark place. Political extremism starts to take root. Anytime there's economic calamity, that creates opportunity for dictators or very bad people who show up and say, in this case, blame the Jews for what has happened and tell everyone, I'm the only guy that can fix it. That stuff doesn't work when economic times are good, because you go, what is this guy talking about? Like, I'm making good money, my portfolio's going up, etc. But when times are bad, that is when we are most vulnerable to someone such as Hitler. So that's in Germany. In America, despair sets in until a new leader by the name of Franklin Roosevelt promised a New Deal, which we will cover later. But before that recovery could begin, the system had to completely collapse. The old order had to die before a new one could be born. In our next episode, we'll enter the heart of the Great Depression, the human cost, the Hoover years, the desperation that forced governments to rethink capitalism itself.